What's up, YouTube? Today I'm going to be talking about how to buy your first or next rental property without using your personal income, even if you don't qualify for a traditional loan. My name is Brandon Cuellar. I'm a mortgage loan originator and I help investors buy these properties every single day. Let's get into it. All right, so let's talk about the program we're talking about. We are talking about a DSCR loan. What does that mean? It's a debt service coverage ratio loan. And the reason why it's so attractive for investors is they don't look at your personal income. All we're caring about is the property income versus the mortgage payment on that property. So this is a little bit different than qualifying for traditional income. There's no debt to income qualification. There's no looking at your tax returns. There's no looking at W-2s or anything like that. All we're looking at is the property income versus the payment. So it's much more seen as a business, and each property is pretty much its own business in the eyes of a DSCR loan. All right, so let's talk about who a DSCR loan would be good for and who it's not good for. Who it's good for is typically a self-employed person, someone who maybe makes a decent amount of money, but on paper, not so much. Maybe they have a lot of write-offs on their tax returns, things like that. Also, maybe someone who's a full-time real estate investor. So this is all they do. And again, they have so much write-offs on their taxes that they wouldn't qualify for a conforming loan. All right, now let's talk about who would not benefit from a DSCR loan. If you have a W-2 income, whether you're commission, salary, hourly, something like that, but you're paid W-2 and you don't have any current properties that have a lot of write-offs on your taxes, then this probably isn't going to be the best option. Your best option will be a conforming loan. You can still buy an investment property. You are going to save a little bit on the interest rates. I will say there's not a huge difference when it comes to DSCR versus conforming in terms of interest rate, but there are some other factors to consider. So I always say if you can qualify under a conforming conventional loan, that's the best route typically. But for who I'm talking to today, most people, that's not an option. So again, we have two different options. We have DSCR and conventional. Now the DSCR, there's no income verification. All we're caring about is the property income versus the payment on the mortgage. And then we have the conventional option, which we're actually looking at your personal income, your personal debts. Where are you living now? What are you paying at your current property, and factoring that into a debt to income calculation. So two very different ways to look at it that get to the same end result of buying that first or next investment property. All right, so the next question you might be wondering, how do I qualify for a DSCR loan? It's a great question. So there's three key components to the DSCR loan to make sure you qualify. Number one, credit score. We want to make sure that you have at least a 620 credit score. Ideally, of course, the higher your credit score, the better your terms will be, but the DSCR lenders will go as low as 620 credit score. Now let's talk about down payment. DSCR loans require at least 20% down. Of course, the more you put down, just like credit score, the higher it is, the better the terms. The more you put down for your down payment, the better your terms are going to be, but they will go as low as 20% down on the down payment. Another crucial thing for DSCR is reserves. The way that underwriters look at it is they want to make sure that when you buy an investment property, you have 6 months of reserves set aside just in case a repair, a vacancy, maintenance costs, different things like that come up. So make sure you have 6 months in reserves in a bank account. This is another thing that I want to talk about. Your reserves must be verifiable in the bank. We're not talking about cash under your pillow, but we're actually talking about money in a checking, savings, stocks. It doesn't necessarily need to be liquid, but it needs to be liquefiable, if that makes sense. I don't know if that's a word, but pretty much if it's a stock, you can sell that very quickly and cash it out. If you can't use another piece of real estate as reserves, that makes sense. All right, now that we've talked about how to qualify for a DSCR loan, let's talk about the next most important thing, the DSCR ratio. Remember, DSCR stands for debt service coverage ratio. So what does that mean? What is debt service? Debt service is the monthly payment. If I'm servicing my debt, that means I'm paying my debt. How much is it covered, right? Debt service coverage covered by the rent. So ideally, that number would be above 1.0. What that means is the rent meets or exceeds the monthly mortgage payment, including all taxes and insurance. So let's say you have a mortgage payment with taxes and insurance of $3,000 per month. Well, your rent should be at least $3,000 to qualify for a 1.0 DSCR ratio. Now, in this market, this is being filmed in May of 2025, that can be a little bit difficult at times. I see a lot of investors going to smaller markets to try to find properties that meet or exceed the 1% rule when it comes to the rent versus purchase price ratio. Now, that's a whole nother separate conversation, but ideally you meet that 1.0 DSCR ratio. Now, if you don't, that's not the end of the world, but keep in mind the best terms you're going to get for a DSCR loan are going to be at least 1.0. We have different programs that are 1.0 and up. We have anywhere between 0.7 and 1.0. So you have a little bit of a difference there in terms when it comes to loan to value and interest rate, things like that. And then you even have something called a no ratio DSCR loan. Pretty much they do not care how much the rent is versus the mortgage payment. The DSCR ratio could be 0.2 and you could still get the loan. Now, why would you do that, right? That doesn't make sense as an investor, right? To have a 0.2 DSCR loan. That means that your mortgage payment is $1,000 and it's renting for $200, at least on paper. So the reason why that is the long-term rents may be that $200, but you may be a short-term specialist, right? You may have some experience on Airbnb, or you may rent out to maybe traveling nurses, maybe you do midterm rentals, something like that. That is where a no ratio loan may make sense for you. Okay, let's talk about property type. DSCR loans can be used for lots of different properties. There's a couple things that I would consider. I would try to stick to either a suburban or urban property type. So most of what we see, every once in a while we have something called a rural property. So something that's a little bit further, out in the country. We can definitely finance these properties, but whenever you get into the rural, we start dropping off lenders. So for instance, I'm a broker. We have about 7 or 8 different DSCR lenders that we work with. Well, only about 3 or 4 of them will even finance rural properties. And the ones that will, the loan to value restrictions go down. And what that means is you have to put either more money down, or if you're doing this as a refinance, you can get less money as your loan amount. So keep that in mind. So as an investor, when you're buying or maybe refinancing this property, if you're refinancing it, probably not as important because you already know what it's going to rent for, because most likely you already have tenants in there. But if you're purchasing the property, it's very important to have either some great knowledge yourself or a great realtor on your side to know exactly what the property will rent for. The reason I say that is whenever you're purchasing a property, what we'll do is we'll send out an appraiser to get an appraisal of the property value. So what is this property worth? Let's say it's worth $500,000. Well, they're also going to do something called a rental comparison. So what they're going to do is look at rental properties in the area that are similar to that property, and they're going to say this property will rent for $2,000 a month or whatever that number is. We want to make sure we know what that number is going to come back at before you go under contract on a DSCR loan, because we want to make sure that you don't get kind of stuck in a hard place. We want to make sure that we know what the DSCR ratio is going to be. I've seen investors where they go into it very hopeful, very ambitious, thinking this property is going to rent for $4,000 a month. When it comes back and the rental comparison is $3,000 a month, now the DSCR ratio changes, and when the DSCR ratio changes, the interest rate and the terms, the max loan to value, all these things can change so quickly, and it can be very jarring for a new investor. So that's super important to make sure that you know what that property is going to rent for before you even go under contract, to make sure you don't have any surprises down the road. All right, now let's talk about how to choose a DSCR lender. This is something that I would recommend leaning on a mortgage broker like myself. The reason why I say that is if you go directly to a DSCR lender, just like we talked about the rural thing, they may not be able to do that. They may not be able to do maybe something that's a short-term rental. We have certain DSCR lenders that will allow for short-term rental comparisons, and we'll order that with the appraisal. And so when you work with a broker, they're able to talk to 6, 7, 8 different DSCR lenders on your behalf. And when we talked about, yes, of course, shopping for the most competitive rate, but also the most competitive terms. And so it's not just about interest rate for DSCR. A lot of it is also trying to max out your loan to value. It's also trying to reduce your prepayment penalty. And that's another thing that a lot of people don't talk about when it comes to DSCR loans, is almost every DSCR loan has a prepayment penalty. This is very unlike a normal primary home. So for instance, in Texas, which is where I'm at, there is no prepayment penalties allowed when you're living in your own property. So if I'm buying a property to live in it is not allowed for any lender to assess a prepayment penalty on that property. Now, when it comes to DSCR, this is an investment property. Typically, the industry standard is a 3-year prepay penalty, which means you have to keep that loan for 3 years, or if you pay it off, whether you just pay it off in cash, sell the property, or refinance it, you're going to have a fee to pay if you do that within the first 3 years. Now, that fee does vary depending on lender, and that's why it's great to get with a mortgage broker, so you can not just compare the interest rate, not just compare the loan to value, but also compare the prepay penalty terms. All right, the next thing I want to talk about is the timeline. How long does it take to close a DSCR loan? Now, the industry standard for closing on properties, just in general, at least in my market, is 30 days. Now, what I always urge investors to do, especially when there's so many moving parts, if we can negotiate a 45-day closing, I think that really helps. And the reason why it helps is it removes the stress. It helps just make the process a lot smoother to where you're not kind of scatterbrained. Because DSCR loans, yes, they're very simple, but there are quite a few moving parts, and the extra time helps, give some breathing room, especially for at least a lot of my folks who are getting DSCR loans are business owners. They have a lot going on in their lives, and sometimes it's really difficult for them to pull away from that to get me some much needed documentation. So I would say the industry standard 30 days. If you can get 45 days to give yourself breathing room, great, but if not, 30 days will definitely work. All right, so I'm gonna give you a couple tips on DSCR loans before you let me go. The number one thing I would say is maintain a high credit score. DSCR loans are very, very delicate to credit score changes. What I would recommend is staying above 700 credit score for the best terms possible. The reason why is when you dip below that 700, you have a lot of loan to value restrictions, and you're not able to maximize the leverage you're able to get on that DSCR loan. Next tip is focus on 1.0 DSCR properties if at all possible. So again, what that means is the rent at least meets the mortgage payment or exceeds it. So make sure you try to focus on those properties. You're going to get the best terms when you have at least a 1.0 DSCR. And the last tip, again, is to make sure you verify your numbers. As an investor, I invest in real estate myself. The only times I've gotten burned is when I don't double and triple and quadruple check my numbers to make sure I'm not going to be in a pinch. Also, it's super important is make sure you have an exit strategy. If you're purchasing a property as a DSCR loan, I would highly recommend know exactly what that's going to rent for, but also know your exit strategy. If it's something to where you need to sell in 6 or 12 months, know exactly what you're going to do, exactly what the prepayment penalty fee is, and make sure that pencils out for your deal. And the last tip I have is go to smaller markets. I have a lot of investors that go to different markets to have a better rent to price ratio. For instance, I have an investor who has a portfolio of properties out in Tulsa, Oklahoma. He actually just purchased a property for $75,000, ready to move in, and put a $1,400 a month Section 8 tenant in that property. So let's think about that. That's almost the 2% rule. I know a lot of investors are struggling just to get the 1% rule, and he achieved almost the 2% rule. So if you're okay with out-of-state, long-distance investing, I think smaller markets will get you a much higher rent-to-price ratio. Of course, you're going to sacrifice the long-term appreciation of investing in bigger markets, but it's all a trade-off, and it all depends on what your long-term goals are. All right, to recap, DSCR loans are fantastic options for self-employed people, full-time real estate investors, pretty much anybody who doesn't have verifiable income on paper. If you got value out of this video, do me a huge favor, like the video, subscribe for more videos like this, and share this with a friend. I'll see you on the next one.